What is up, everybody? In this video today, we are going over 3 safe, high-yield dividend stocks that you should add to your portfolio for that passive income, that cash flow shit we all trying to get. So you guys, without further ado, let's just get into the video. First things first, y'all, if you are new here, what is going on? My name is Nikki, and it would mean the absolute world to me if you would consider subscribing by hitting the Indie in the bottom corner or the sexy OG red subscribe button right there down below the video, and join the crew, join the journey on this channel. I post minimum 2 times a week. We try and 3, but minimum of 2 times a week. Basically just entertain you and document my investing journey and my side hustle money journey, and just try to have a good ass time and make some money. So if you're into that, or if you are into hanging out with me half as much as I love hanging out with each and every single one of you, please consider subscribing. Alright, everybody, so real quick before I get into the 3 stocks, and I will disclaim by saying 1, I own, I love, I've talked about it many a times, you may already know what that is, but 2, I have had on my watch list for a long time. I keep an eye on them, and we'll get into that. But I want to talk about 2 things first that's very important to look at when we're talking about dividend stocks. Now, I know I said 3 safe, high-yield dividend stocks. So the biggest part of this for me is the safe part. As a dividend investor, if you are solely relying on those dividends to fund your life way down the road, you need to make sure that shit is safe. So yes, we can find stocks that have a 20% dividend yield, but that isn't right, and I'm gonna tell you why. Because the first reason is we want stocks to have a very low, and by very low I mean usually 60% or less of a payout ratio. And real quickly, what a payout ratio is how much of the earnings are being paid out to the shareholders in the form of dividends. So over 60 is a little too close to 100, and there's stocks with like 150, 250% payout ratios. So the reason we want to keep the payout ratio under 60% is because the closer it gets to 100 means more of that company's earnings are being pushed out and not put back into the business. So that's not very sustainable. A lot of these companies with a 20% dividend yield are using all, if not more than, money that they have to pay you, which is not sustainable and not safe. So I understand that these stocks I'm about to give you do not have a 12, 15, 20% dividend, because I truly just don't think that is safe whatsoever. So I'm going to provide to you 3 safe, higher yield dividend stocks because I want you guys to be smart and safe. And the second reason that these stocks are on this list is because I'm also looking at the payment history and the growth history. Is it consistent? Are they raising the dividends on a good basis? Because if a company has been paying it out forever and ever and ever, they're not going to want to mess that up, and it's more likely safe with a lower payout and a greater consistency rate than some high ass yield dividends, which you should probably run from, to be honest with you. But hey, you do you. I'm just a girl trying to entertain y'all, documenting my damn journey. So in addition to that, I want to let you guys know I used simply Wall Street to kind of do my research and my data analysis and stuff like that. It is something that you have to pay for. You can give it a trial, I believe 14 days for free or something like that. Just, I don't have a referral link or nothing like that. Just type in simplywallstreet.com and check it out for yourself. But that is the tool that I was using for kind of this analysis, and I will pop it up on the screen probably for a couple things that I want to mention on here. So just so you know, that is what I'm using. Alright guys, so the first one that I want to talk about is IBM. Now, I think I mentioned this before, and this for me would truly just be a dividend play. I think there is room for it to catch up to pre-COVID levels. Like if we look right here in the last year, I mean, you can see here right before COVID happened, we're in the 150s, and then it had that tank pretty much like every other company and stock in the market, and now we're kind of cruising at this area of the 120s. So if I pull up the 5-year chart, it's not great. I mean, I technically would like to see some sort of upward trend. This doesn't look like it has it, but for the fact that maybe it could catch up to pre-COVID, it might be good to get some capital gains in there. I'm not sure about the whole capital gain part, the profit part on this one, but I am sure about this dividend play. Now, as you can see, Robinhood gives it a 5.48, and I am aware and I do understand that Robinhood's dividend percent yields are a little like wishy-washy on some of them. They're not totally accurate. So I'm going to cover the rest on my Wall Street app. So I'll go ahead and pull that up for you right now. So this is specifically the dividend chart on my Wall Street app for IBM. So IBM is International Business Machine, so it's like a national tech kind of company that's software, programming, cloud computing, tech kind of related crap. I mean, you've probably heard of it. I don't need to go too in depth about it, but as you can see here, they have a 5.51% dividend with a 6 out of 6 for a safety. You can see the company versus the market, all these kind of things. But a couple things I wanted to know right here is right here where it says high dividend. It says IBM's dividend 5.51% is in the top top 25% of dividend payers in the US market. So it's in the top 25% for its dividends, even though it's only 5.51, which I think is still pretty damn high. Like I said, my comfort level is like a 2 to 4, maybe a 2 to 6, but the 5.5 here, with that being in the top 25%, I think is really truly awesome. So as a dividend player, I think this is huge. And right here we can see that the dividend per share has been stable in the last 10 years. They've increased over the last 10 years. That payout ratio right there on that graph is 64%, which is a little higher than the 60 average, but I'm not too concerned about it, because if we look here, future payout, so they kind of like analyze and think about what that PO ratio is going to be in the future for shareholders, and they're saying by 2023 only 52% of the earnings will be paid out. So for me, that gives me an idea that IBM can grow their dividend, and they should grow their dividend, and it is a game plan of theirs to grow their dividend. So that, plus the fact that it is in that computer kind of software industry, cloud-based tech area, security, I think that is in high demand. I don't think tech or the needs for tech or security or cyber coding or whatever is going to be going away anytime soon, and they are such a large industry leader in that sector. So I'm very confident and comfortable with them, especially with that safety score of their dividend and that little tiny additional benefit of possibly growing back up to those pre-COVID levels and continuing to grow over the course of time, maybe possibly, is something else that is a slight factor in benefit for IBM, I think, because obviously their dividends are safe. I think they're covered. They're going to keep growing. A 5.51% is pretty good in my eyes. So you guys, IBM is definitely something I feel like you should want to keep your eye on. In these kind of videos, I'm not really deep diving into the company. I'm thinking about starting, not a series, but just start to upload videos where I kind of pick one stock that I really deep dive into and give you a lot more details about the stock, the financials, the company in and of itself. So if you are into that and you like that idea, please let me know down below if you would watch those, and if you would, what stock you want me to deep dive into. But the sole purpose of these videos is to get these stocks on your radar for you to watch to see if it fits within your strategy of your portfolio for your investing journey. So we're gonna go ahead and move on to the next stock that I have, the next company I'm obsessed with. I've already talked about it. I'm not gonna spend very long on this at all. And you probably already guessed in your head correctly, it is going to be J&J, Johnson & Johnson. You guys, look, they're currently trading about the 143 mark. The 5-year for J&J is something I really do like. This growth pattern right here, even though it's very minimal, it is there. You can see my current position of the two shares. You can see their dividend. Robinhood is saying at 2.71. You can kind of see what's going on there with that, but I'm gonna go ahead and pull up Simply Wall Street so we can look more in depth about their dividend history, stuff like that. You guys bear with me. It's hotter than the devil's playground up in here. Woo, Lord. And then you might be like, Nikki, why don't you just put on the air? Because you know what? Oh my God, my eye's twitching from the heat. What? I don't do that because I'm frugal and I'm trying to save money, and my bill was too much last month. And I'm like, you know how many stocks I could have bought with that? We're not making the same mistake again. All right, you guys, so Simply Wall Street has their dividend here of the 5 out of 6 safety score with a 2.84% dividend. Like I said before, we can see it versus the market. So it's not as impressive as IBM was. Obviously, the dividend yield itself is a lot lower than the 5.51%. But what I want to note here is that chart right there. Look at the analyst forecast for this company and for the dividend payments. And then to move right along here, I mean, J&J is not only a dividend aristocrat, which means they've been growing and paying for 25 years, they're a dividend king, which is 50 years. So they've actually been paying this dividend for 57 years. So it's not a surprise that they are stable in the past 10 years for both the payments and the growth. And kind of just like IBM, they're saying it's a 58% payout ratio right now, which is better than IBM. And it is projected to drop down to 52% by 2023, which is sick and dope and crazy because that just goes to show that this behemoth of a company is going to take care of you and your damn money. I honestly truly see them as such a big blue chip company that I literally see them as like a healthcare ETF. Their product line and brand line is so diversified with they're doing a lot. They got pharmaceuticals, they got medical devices, they got consumer goods like lotions and oils and baby stuff. Like, it's all over the damn place. And so I'm not gonna spend that much longer talking about J&J. Honestly, you guys have heard enough, but the fact that they are kings, they are so well diversified within their own product line, I just can't feel anything but comfort when I think about J&J. And so for that reason, it is definitely on my top list for one of the safest dividend stocks that you should probably have in your portfolio. All right, everybody, so the next one is one that I've actually never talked about before. I feel like I say that a lot. I've recently just added them onto my watch list. I've kind of had them in the back of my brain, but never really focused on them. And they're a company that I think could be very, very well set for not only right now, but the future as well, and your dividend. Ooh, girl. your dividend is going to be safe there. And you guys, I don't know, this might be a hit or miss for some of y'all, but that one is going to be Caterpillar, currently trading around the 128 mark. That 5-year look good right here, and then we're kind of like, what's going on? But like I said, this is a dividend video, so let's focus on that. I don't currently owe them, as you can see, and a PE ratio of 13. So those are just some basic stats for all y'all. That's Caterpillar. I know a lot of people that do have CAT in their portfolio, so let's go ahead and jump over to Simply Wall Street to kind of get into more nitty gritty of the dividend. So you guys can see that their dividends of 3.22 on here, 5 out of 6 safety score according to Simply Wall Street. We can see if you buy it now within the next 4 days, you can receive the upcoming dividend payments. So if you were thinking about this, maybe you want to jump on it and get your money sooner than later. And then just like the other ones here, they've been stable for the last 10 years. They increased over the last 10 years. They are a dividend aristocrat. They are paying and growing their dividend for the last 26 years, so they're pretty new on the list, but on the list nonetheless. They're coming in at the lowest payout ratio that we have on the list at 43%, but in the future they do think it's gonna rise to 62 by 2023, but even 62 for me is still safe. I would get freaked out more like 75 or 80 and above, so 62 for me, even then I'm like chill with it. And 2 reasons outside of those like kind of safety number dividend analytic things, I really like this company because, one, construction. I firmly believe, being in the real estate industry myself, that real estate is going to be needed for a very long time. Yes, we're in the digital economy, the e-commerce area, and a lot more shit is being done online, but I truly still believe there's always going to be a need for the construction industry and anybody who supplies to that industry. People are always going to need a place to eat and sleep, so I just, you know, construction for me is pretty damn safe. And obviously they do more than just construction. They have like mining equipment, natural gas, diesel. They've got other things, but I'm kind of looking at it mostly for, not mostly for, but a big part of it as construction. I mean, you see the tractors all around. Like, I just think it's safe in the industry that it's in. And the second reason why I kind of perked my interest was because of the whole idea of how customer focused and growth focused they actually pretty much are. So I'm gonna read this from the website. It says that obviously they're the world's leading manufacturer of construction and mining equipment. They are also a leading financial service provider through Caterpillar Financial Services. They're built for customer success. They are in it for the long haul. Our customers can be found in virtually every corner of the earth, and we realize our success comes directly from helping our customers be successful. They got the right idea, and their customers are everywhere. Real estate is everywhere, mining everywhere, projects everywhere, dirt everywhere. And they also have a thing called the Caterpillar Foundation, founded in 1952, that helps make sustainable progress possible around the world through support of environmental sustainability, access to education, and fulfillment of basic human needs. So they just have this long-term global kind of customer related change the world kind of attitude. And it says here that they're using leading edge technology to provide customer solutions, trying to move dirt with less fuel, developing products that generate fewer emissions, or exploring vehicle solutions. Our strength is integrated customer feedback with ideas and actions to ensure our customer success now and in the future. So the thing that I really liked about that is it says that they want to generate fewer emissions, so carbon emissions, the footprint, kind of look at the hybrid between electric and lowering that carbon footprint, lowering fuel usage. And not to say that they're Tesla or will be ever close to Tesla, but it is to say that it's in their brain, and that's kind of all we can ask for, is that companies are aware of an ever-evolving economy and world. And I think Caterpillar understands that, and I think they really value helping their customers and basing their business model off what their customer needs, that they may be a decently set growth here for the long term. Because I just think that if you're fully involved and fully understanding of what your customer needs, you're going to be changing your business and evolving your business to the needs of who is going to buy your service. So I think that's just a really good move on their part. And the fact that they have a good safety, they're dividend aristocrats, and they don't really want to mess that up. Do you guys have Caterpillar in your portfolio? I've been thinking about it. I don't know. Should I pull the trigger? Should I not? Let me know down below, please, for you girl. And y'all, I have got to get back out there and get on my Call of Duty grind. I've been playing Call of Duty like it's my job lately, like the Warzone, the new upgrade from Modern Warfare. Your girl is kind of trash on the new upgrade. It's hard. It's so hard. Oh my god. So you guys, if you enjoyed this video, if you enjoy anything stock related, investment related, and you're this far, so far, please subscribe to the channel, hang out with your girl, let's go on this journey together. And if you found any value in this, or you like my choices, even if you don't like my choices, if you could just smash the damn like button, it helps me so much. YouTube likes it almost as much as I do. And you already know, if you are hearing my damn voice, you gonna get some kisses. Come here, you are the real MVP. You know I love you. And you guys, without further ado, go ahead and tap the video that's about to be on your screen, and I will see y'all in the next video.